Well, it would appear that the controversial Div 296 proposal has well and truly reared its ugly head again after the re-election of the Albanese federal government, and particularly so after the composition of the Senate is becoming clearer. With the Greens almost certain to have a balance of power veto over Anthony Albanese's second-term agenda, the new leader, Larissa Waters, has declared she sees no difficulties with the unrealised gains tax plan, despite the Greens having held up the proposal before Labor's election landslide. It has been reported in the mainstream media that Labor intends to use the Greens' depleted power to pass an unrealised capital gains tax on superannuation accounts worth more than $3 million without any indexation as to the assessment threshold. Whilst Chalmers insists that there are similar taxes on unrealised capital gains in areas such as land tax and local government rates, we should note that such taxes are not levied at the federal level, but rather at state and local government level. With the exception, of course, of the mendicant state of Victoria, rises in these taxes are generally modest. Whilst it's difficult to predict the passage of legislation, it would appear that we should reasonably expect the legislation to pass in accordance with the Labor Party's agenda, and, given Chalmers' previous comments, the trigger date may still be 30 June 2025. In other words, this date may be retrospectively imposed. This then begs the question as to whether immediate action should be taken in this financial year to mitigate the potential impacts of Div 296, or whether a prudent advisor would advise that you don't act immediately, but you act pre-30 June of the first assessment year, would be 2026. The proposed legislation raises some interesting issues that clients need to be looking at to minimise the impact of the regulations. The most relevant issue is linked to the concept of the total superannuation balance, and we are expecting to see a legislative change around the definition of total superannuation balance. Since its implementation, the total superannuation balance has often been seen as the aggregate of the members' superannuation benefits, generally calculated at market value. However, the total superannuation balance and the members' account balance may well be different and distinct, and need to be seen in the context of the new Div 296 measures, particularly in respect of retirement phase account-based pensions. Typically, the element around the retirement phase value was quite clunky with reference back to the modified transfer balance account and having a starting point of debits and credits being removed and then effectively looking at your account balance. It was an overly clunky way of asking what the value of your pension is on 30 June. The current practice of defining an individual's TBA does not, in most circumstances, take into account the net value of an investment after the realisation costs are taken into account. The net realisation costs would not only include direct sale costs such as brokerage or property sale expenses, but also capital gains tax. Therefore, it's likely that an accurate value will need to be calculated for the purposes of assessing the total superannuation balance and whether Div 296 liabilities may apply. It'll be interesting to see whether there is a move to tax-deferred accounting rather than cash accounting within SMSFs. The deferred tax model allows the current and future tax consequences of book income or loss generated by the enterprise to be recognised within the same reporting period, providing a complete measure of the net earnings. Of particular importance going forward will also be a consideration as to whether a pension should be commenced with a reversionary nomination to an eligible beneficiary, or whether there may be a move to non-reversionary nominations under certain circumstances. In the event of a reversionary nomination, the pension continues to be paid to the eligible beneficiary, and the receiving spouse will have the reversion amount counted towards their total superannuation balance immediately. In comparison with a non-reversionary pension, until the trustee resolves to start paying a new pension to the surviving spouse, the surviving individual does not own the balance, and it will not count towards their total superannuation balance. This difference in counting may have a significant impact as to whether the surviving individual will be subject to the Div 296 assessment. To complicate considerations, for the purposes of the transfer balance cap, the value of a reversionary interest at death is taken into account in respect of the beneficiary 12 months after the death of the original pensioner. In comparison, the value of a non-reversionary pension will be taken into account at the election to commence a death benefit pension and in the amount that represents the value of the pension interest at the commencement. The differences in the counting methodology and timing may well rise to a reassessment of whether a pension should be reversionary or not. And finally, the General Transfer Balance Cap, the TVC, will be indexed on 1 July 2025, increasing from $1.9 million to $2 million. This increase will impact members with a personal transfer balance cap. Members who have commenced a pension, a retirement-based pension, prior to 1 July 2025 and haven't previously reached or exceeded their personal cap will be eligible for a proportional increase based on their highest ever transfer balance and the amount of the unused cap space. If you need any assistance in calculating an entitlement, particularly where a client has an existing unused cap space, please don't hesitate to reach out, as I have access to a terrific calculator. As always, stay tuned for updates.